Why do some property investors manage to develop a substantial property portfolio, grow their wealth, have financial independence while most don't? You've heard the fact that 92% of investors never get past their first or second property. Today I have a chat with finance broker Aaron Christie-David, and we're going to talk about a lot more than just money and loans. We're going to get his insights into why some of his clients have become very successful in property investing. And interestingly, it's very similar to what I've experienced with our clients at Metropole. So if you're trying to get some clarity in the chaos of all the mixed messages at the moment, if you're wanting to take advantage of this new phase of the property cycle that's we're entering right now as interest rates are slowly falling and as confidence is returning to the markets, you're going to enjoy our chat today. And hopefully at the end of it, you're going to come out with some ideas, some hints, some clues as to what you can do a little bit different to make your property investing more successful. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, my guest today is finance broker Aaron Christie-David. We're going to be talking a lot more than just money and loans. Aaron is the co-owner of Atelier Wealth together with his wife Bernadette. And since launching in 2016, Aaron and Atelier Wealth have received quite a few industry accolades, including being ranked within the top 100 brokers 4 years in a row. Aaron's also the host of the Australian Property Investment Podcast. So welcome, Aaron.
Thank you very much, Michael. Really happy to be here.
Well, Aaron, I know you well, but many people listening to this podcast may not have heard of you. So let's start with what qualifies you to even talk about money and finance, Aaron.
Thanks very much. Look, I've been in finance and mortgage broking 10 years. Over that time, I've seen thousands of clients come through us, and we've worked on all sorts of scenarios from the most difficult to your first home buyers. And I think sitting within that, there's probably very rarely a scenario that comes across my desk now that really throws me. Obviously, everyone's unique and has their own, effectively their own thumbprint on what they're trying to achieve. But to me, it really boils down to financial freedom, not walking around with a 30-year mortgage, trying to create intergenerational wealth. And I think once you kind of sift through what everyone's unique goals or aspirations are, they generally come out in the wash that they want to work less, they want to save more, they want to invest better. And I think once you distill that down, the secret sauce on top is how you actually get someone from where they are to where they want to get to with minimum friction.
Well, I've often said that property investment's a game of finance with some houses thrown in the middle. Some people don't even know how to use the finance bit right. I mean, a lot of investors get the property bit wrong as well. But people seem to be working hard for their money. But are they getting their money to work hard for them, Aaron?
That is the exact clincher that I say to a lot of people. It's what I deem it sweat equity. And so the amount of people that go to work and work extremely hard in their day-to-day jobs, and then you look at, are they living paycheck to paycheck? Are they propped up by credit cards or buy now, pay laters, for example? And it's these money habits that are generally holding people back. You'd say rationally, it makes sense to buy an investment property or properties for your future, retirement, to leave your kids something, for you to have a nest egg as well. So in one hand, it rationally makes sense. Emotionally is where the game is won and lost. And when you talked about, say, the game of finance, it's not about being creative with lending, for example. It's managing cash flow. It's managing tenants. It's managing a tax return, for example. Now it's managing an accountant or financial planner or a buyer's agent. That to me is what the game of finance and property investing entails. It's an ability to step up. It's ability to take on some extra challenges. It's ability to be a little bit uncomfortable. But you and I both know that when you cross over to the other side and you've done it successfully, the fruits and the spoils and the rewards are there for those that have persevered and pushed through. And I think so many times property investing is sold in like the property or the location is where the game is won and lost. We disagree and I go against the grain quite openly. It's a matter of mindset and it's a matter of persistence that comes through in the most successful investors.
Resilience and also, I think, the ability to delay gratification. Aaron, I agree with you. The media often asks me, Michael, what's the difference between the successful investors you deal with and the average Australian? And it's not their education. And Aaron, it's not even their income. I'm sure you've seen high income earners not using their money properly either. It is the way they think. And unfortunately, it's not their fault. Australians are not necessarily financially fluent, and they haven't been taught by their parents. Not many of us have had wealthy parents to learn these good money habits from.
Yeah, it's a term that I use. You can't be what you can't see. And I feel that's where, like, our podcast, your podcast, there's so many, like, you take your plethora of podcasts. There's not a shortage of information. In fact, there's probably a lot of information out there.
Probably too much.
But here's the thing. Now, if there's so much information, why aren't you doing anything with that information? And now it's a matter of being resourceful. So you've got all these resources at your fingertips, YouTube, you've got podcasting, you've got ebooks, you've got books, for example, and you've put out books. I've put out a book. To us, we're saying we're going to give you as much information as we possibly can, but what are you going to do with all that information? And the property market rewards action takers and decision makers. And unfortunately, in 10, 15, 20 years' time, when you look at people and how they've built a portfolio, they've made mistakes, it's cost them money, but the ability to hold on for the long term, you call it delayed gratification, or just an ability to, a bit of grip strength and hold on for quite some time, that's where the game is won and lost. And I feel like there's so much media message that's peddled out, and these are the hot spots, and here's how to get a 20, 30% return in 1 year. That will suit a particular investor that's looking for a shortcut. The investors that I work with, the investors that are successful, are the ones that shut out a little bit of that noise, that just keep walking on a tried and tested path of buying quality assets, not quantity, for example, by having a team around them that they trust. But most importantly, they're putting themselves in the driver's seat to create leverage and stack the deck in their favor.
Now, that's interesting. I've just found that many investors just don't reach their full potential. And it's because they spend a lot of time learning, as you say, reading blogs, listening to podcasts, watching YouTube videos, but their results equal their potential minus their constraints. And they don't focus on those. And that's where the challenge is. They've got bad habits about money. I guess it's the difference between the knowing gap and the doing gap. If they just did what they knew, they'd be much more successful, wouldn't they?
Mate, you could read a book about riding bikes and watch videos about how to ride a bike, for example. I've got two very small daughters, and we're going through this exact phase at the moment, learning how to ride bikes. I could show them all the videos and all the books and all the step-by-step guides. They could see other kids ride bikes as well. It's actually until you put a helmet on them and put them on a bike, and at some point take the training wheels off, that they're actually going to learn how to ride a bike. If I could break that down, the most simplistic example that I could. So when it comes to property investing, you can take your pick. You could go subdivisions, you can go granny flats, you can go commercial, you can go residential, you can go renovations, you can go cash flow, you can go regional, metropolitan, units, apartments. And people then go down that rabbit hole of like the mechanics on how to invest. And when you zoom out a little bit going, but what happens when you have two tenants that vacate at the same time, you're negative $1,000 a week because they're $500 a week in rental income? The books, the podcasts, the videos, the how-to guides are not going to tell you how to step up in that moment and go, well, what you actually need is you need some cash buffers in place. You need to have provisions for being able to rent for maybe 3 weeks on each property, because that's how long it takes to kind of generally go through a mediation type approach. You need to have buffers in place for hot water systems, because it's not a matter of if something goes wrong, it's a matter of when something goes wrong when you own property, for example. It's a matter of going, right, you got insurances, it's raining all the time across the country and flooding somewhere. So it's like, well, how do you have buffers and provisions in place for that? And that message just gets pushed down, because the messages that get amplified are, is this the right time to buy? Is 2025 the good time to buy an investment property? How did how these investors get double-digit returns? Or buying through a trust is a secret bullet to building and scaling a massive portfolio, for example. And they're the messages that generally come and get top of voice when it comes to property investing. For you and I, the unsexy, the less amplified message of property investing is actually the mindset, and then the methodology that comes with holding and scaling. And you asked me what we do, and that's very much where we sit as that strategic mortgage broker, going, it's not loans that we're pushing people to buy property when they can, where they can, how they can, and where they can afford to buy as well.
I'd add something a bit further, Aaron. You're actually also buying them time, not just property, but if you actually have the financial buffers in place, then you're buying them the time to ride the inevitable issues that occur, like you said you would. Now, I bet there's some people listening to this or watching this saying, hey, he's speaking to a mortgage broker. When they're going to talk about interest rates and fees and the good stuff, we will. But in my mind, this is actually the important stuff, the good stuff, isn't it?
Mate, I'm the worst mortgage broker there is in Australia. And I'm not being flippant about I don't look at rate, but I'm like, we're not buying loans here. We're buying property, and the loan is simply the vehicle to go and buy more property. And until that penny drops for a lot of investors, because that's effectively how we're sold loans, right? Let me just explain this. No one ever looked at a car loan and decided not to buy a car. The car to me represents freedom. It represents status, for example. You might be early on in your car ownership, and it's like, it's a ticket to freedom. And so the car loan, when you look at it, on paper, doesn't make any sense. You're paying far more interest over time. The car depreciates in value. It costs you more, right? It's maintenance costs. So I'm like, hang on. It would actually make far more sense to buy an income-producing asset, i.e. an investment property, which increases over time, gives you cash flow, and you can go and leverage that to go and buy more property. But no one ever says, hey, the car interest rate, the car loan rate's far too high. That's it. I'm never going to buy a car. People go and buy a car every single day of the week across Australia. And so to me, I'm talking to a very small cohort of Australians that are willing to do what the masses are not, which is avoid the temptation of getting into car loan debt, stack that money into income producing assets. When the assets get big enough and cash flow gets strong enough, then you can go and buy a really nice car. And I can only say that because I live and breathe it. My car is very modest, and I'm my business at a point where it's giving me strong income, and I've got a good lifestyle. But I'm not using my car as some type of flex to go, look at me. I'm trying to buy more assets. And if your broker can look at you in the eye and say, this is exactly what they're doing, I'd say take the advice from them. Take the advice from someone that's been on the journey or going on that journey as well. Because like you said, hey, when are these guys going to talk about interest rates and trying to get the lowest variable rate for investment interest only? I'd say if you're thinking of buying loans here, you've completely missed the point of investing in property.
Well, interestingly, property is a good investment vehicle. It's stable. It goes up in value. It doesn't fluctuate as much as other assets, but it doesn't give the good return unless you use the benefits of compounding, leverage, and time. So you definitely need finance. And as we said, it's a game of finance. I've found that more and more people are using brokers. I think there was recently a statistic that over 70% of loans are now being originated by brokers. But just like buyers agents, property strategists, and everybody else, there are brokers and brokers. And some I found are lazy. I see very few clients nowadays, but I saw somebody the other day who goes to a broker and it's all with the one bank. Now, it could be right, it may not be, but the way I saw that was they've actually got a lazy broker rather than a strategic broker. And I asked, are these loans cross-collateralized? And she sort of looked at me and wasn't even sure what I was talking about, Aaron.
Look, Michael, you got 22,000 mortgage brokers across Australia, and that number continues to increase. Why? Because broker market share is increasing. So on one hand, I'm super, super proud of what we're doing as an industry, but you take 22,000, and mate, I've got to tell you, there's a very, very long tail in broking. Mate, I've toured around the country recently with our industry body, talking to brokers and doing a keynote for brokers around how, what we've done in our business. And when I hear the challenges that brokers face, and I guess the diligence that comes with it, not all brokers are created equally, and that's not no ego for me. I mean, there's probably some superior brokers to me technically as well. But when I hear a broker say to someone, you should never buy at auction, or I hear you should never use LMI, or I'm like, I had a broker say you should never use a buyer's agent to one of our clients, or the only way you should be buying investment properties is when you each earning $200,000. I'm like, who made these rules that brokers are spruiking? I get mad when I hear this stuff as in being part of the industry, because you're doing such a disservice to people that are ambitious and trying to grow. So say to someone you should never go to auction, I'm like, I've got to question the actual credibility of a mortgage broker that says that. So when you talk about what are not great brokers doing, I look at what the great brokers are doing. I'm talking about they've got a really good lender spread. So what that means is they use a number of different banks. They can take a very strategic view, so they can show you what we'd call a loan strategy. So it's a pathway to property portfolio building. building. So it's property 1, property 2, property 3, property 4. Which properties are we buying through a trust, for example? Where may you hit a wall around borrowing capacity? How do we extract more equity? So doing multiple valuations with different banks, for example, a combination of computer-based valuations or full valuations. At what point do we go through a self-managed super fund? What's the ownership looking like? And when you work hand in hand with buyers agents, and we're talking about a very strategic team and an accountant, for example, the game has just gone to a whole new level. You speak a different language. The client sits smack bang in the middle of this team of consultants who, when the client wins, we all win. And that to me is a really strong equation. The client comes first in terms of what they're doing, and we ride their success. And I think that's where a true team comes into it, when the client sits smack bang in the middle of all these support team members that all sing off the same hymn sheet, as opposed to being in conflict with one another, going, someone's trying to clip the ticket on all parts. It's going, this is what this person wants to do. We're all on the journey to try and help this person achieve their mission. How do we do that together?
I like that idea. Now, there'll be some people listening to this or watching this and saying, yeah, that's all very good, but I've actually hit my borrowing capacity. What can I do? Now, I believe everyone has a borrowing capacity or a limit. Some are it's in the millions of dollars. Some can't even get a loan to start with. But are there ways in today's interesting, let's call it, economic environment to increase your borrowing capacity, Aaron?
Absolutely. There's always ways to increase your borrowing capacity. One is understanding that not all lenders are created equally. So you see that superannuation ad where it's like, it does this, same different results. You could put the exact same inputs into 27 different banks' calculators and you get different results, because banks have different living expenses benchmark, for example. They've got different assessment rates. So in plain English, all that means is you got to understand that different banks will give you different borrowing capacity. So if you're going to one bank, your main branch, and you're getting one outcome, just know that you're probably selling yourself a little bit short there. And then the next part is your liability. So what's pulling you down? So credit cards, for example, a $20,000 credit card could reduce your borrowing capacity by $80,000. That's significant.
Huge.
That's huge. And the counter argument I hear to that is, well, I use it for the points. And then I've got to go, well, what's more important? Is it points or property that's more important? Because from my perspective, property is more important than points. So can you get rid of a credit card and free up borrowing capacity? Because you know what? When the loan settles, you can go off and get another credit card straight after that. So that shouldn't be a deal breaker. Or they've got all their direct debits coming out of credit cards. Again, rightly or wrongly, if that's the way you bank, you've got to understand that it's a limitation on your borrowing capacity. Could you pay out things like HEX or student debt? That again becomes a real handbrake, and that's a political handball at the moment, whether HEX gets factored into borrowing capacity, but it's right here, right now, it does. Loans, car leases, for example, salary sacrificing, that will all reduce borrowing capacity. Even private health insurance, which that to me is non-negotiable, but just know that some banks will factor that in as well. So you can see here, these are the ways that you the levers that will pull you down. When we're talking about levers that will pull you up, your income, there's bonuses, commissions, overtime, allowances. So as much as you can share with your broker when you're talking about how your income is derived. I say to everyone, they're like, oh, my bonus was like, I don't know, $5,000. I was giving me it. Every dollar will count, for example, and just give as much information to your broker where possible and just work out, because to me, it's not about trying to get more debt. It's about trying to buy a superior asset. So if you can increase your borrowing capacity, it takes you maybe from a 3-bedroom to a 4-bedroom, or the property is north facing, or the backyard, the land size is bigger, or maybe it comes slightly renovated. For example, it's not on a main street. That to me is what better borrowing capacity does. It's not that we're going to load you up with more debt. It's the ability to go and buy a superior asset that becomes more important.
So there are lots of things you should consider, and not all banks look at those criteria the same way. So I know people have this tendency of just sticking with the bank that they've had a long-term relationship with. In my mind, it doesn't matter if the logos are blue or yellow or green one. In fact, nowadays it all happens online anyway. You don't see what bank's giving you the money. So yes, see a strategic mortgage broker. I think that's really important, like the team at Atelier. Now, we were also starting to talk a bit before about how people aren't using their money and their equity properly. High income earners, I've noticed, sometimes are just so busy with their lives, the income increases, but they don't actually protect themselves by putting money aside for their future and investing.
Michael, you've nailed it. And I feel like when we have lower income earners, and I say this with all due respect, so I deal with people across all income bands and spectrums. When we take clients that are probably earning sub 100K, their back's against the wall. Their incomes may be capped, for example, particularly their line of work, and they go, right, I need investment properties as a way to generate more income. And because of that, I've got no other option but to buy property and scale a portfolio. Whereas I take higher income earning clients, I'm going to talk maybe 250, 300K minimum, and they move well above that as well, because they're their greatest income producing asset, and they know that as they continue on in a corporate life, their income will just continue to increase and increase, and they can see that roadmap to higher dollars. They don't have that same lack of options when it comes to investing. Generally, what I see is higher incomes, higher lifestyle, private schooling. And again, I've got nothing against this. I think this is great. Higher caliber education, which is wonderful, but the holidays get more expensive. The cars are more expensive. So there's a whole lifestyle creep that has happened at this point. The watches are more expensive, the clothes, everything about their lifestyle now reflects that income level as well. And there's not much left over, surprisingly, to go and invest. And I think that's probably where it really gives them a little bit of an uppercut to go, hey, mate, just like any type of like business, there's revenue, there's expenses, and then there's net profit. And when they look at their home balance sheet and they see the lack of net profit, they're equity rich, so they're paper rich, but they're cash flow poor, surprisingly, even on a strong income. And I'm telling them, you have to go and get another revenue stream, because if you put all your eggs in one basket, when you earn 400K and you're suddenly without a job because of a corporate restructure, it's so hard to get back into the workforce at that 400K. You're not literally going to stroll into another job. A recruitment process at that end of town could take months, and that months has then taken you out of the market, for example. There's a loss of confidence. There's a loss of time. I don't think there's a lot of people that are talking to the need for buying investment properties at that top end of town, because they sink a lot of their money into owner-occupied properties, and then there's not very much left over. And to say go and buy an investment property at 600, feels like they're buying cheapies, and it's a little bit below them to be buying cheapies.
It's interestingly one of the mistakes I've seen some very high net worth, high earners make, and buy their big trophy home too soon. I'm not saying they don't deserve it, but they can't usually afford it at the early stage of their careers where they buy that very big home, and then they've got a bigger mortgage to pay. It's not tax deductible, and it actually takes them out of the property investment market for quite some time, Aaron.
This is it. And they know they should be investing, but what they want to do is probably invest in really expensive areas. And so you got to understand the yields on those type of properties are very low. Yes, you might get really strong negative gearing, particularly on those incomes, but there's not a scalability that happens, because you might get stuck, like you're saying, they'll hit a wall around borrowing capacity because they're servicing a very high home loan or very high mortgage. And like I said, there'll be probably car loans and leases that come off the back of that as well. So it's how do we clean house a little bit? How do we get rid of the dead debt, that dead wood? And how do we find a way that's going to accelerate? Because I still think you can have both. I still think you can have an owner-occupied loan and investment properties. We've just got to manage cash flow at this time. And I think we said at the very start, there's buffers that come in place that then have that sleep at night factor. That is, if or when something goes wrong, the world continues because we've got financial contingencies in place. That becomes critical, irrespective of what income band you sit in.
Well, you talk about cash flow. I find investors get stuck with cash flows they're trying to scale as well. They're reading on the internet, they're seeing on social media, you can buy 10 properties before Christmas or 7 properties in 7 minutes. But when they actually go to try and get the loans from that as they grow, they just can't cope with the negative cash flow. So some go and buy secondary properties where there's a little bit of positive cash flow, but they're not going to get the capital growth to go forward. How does an investor scale with the cash flow challenges, particularly at the moment where interest rates are just a little bit higher than we'd like them to be?
Mate, spot on. There's when you look at rates versus what you're getting for a yield, and whether you take a gross rental yield or you take a net yield, which is after all your costs, like after your expenses, property management, bits and pieces, bills as well, utilities, once that comes out and what you're actually left over with. I'd say majority of investors are still having to dip into their own pocket to cover the gap, which is you're negatively geared. I will see, and I can show investors a pathway to go and buy 6, 8, 10 investment properties, and they're looking at, but by the time we get to our third, we're negative cash flow. That's why I say, hey, look, just think about that sentence you said there for a second. You've bought 3 investment properties, and that could take you, I don't know, 12 months. It could take you 18 months, depending on the speed that you want to acquire at. But the game will change at that point. Maybe rates come down a little bit. Maybe those rents go up. Maybe your income goes up. So stop worrying about where you get in 3 years' time. Worry about putting one foot in front of the other. Go and buy that first property. See how it works out. Get the confidence. Then go and buy the second. Get your confidence. Get a cadence going. Then go and buy the third. And at that point, instead of sitting on a spreadsheet and worrying about a red line in 2028 in the last quarter where you might be negative cash flow, make some changes now where you can strip out some lifestyle expenses, build up a cash buffer or an equity buffer that you've got, and that will give you that ability to hold on. And I think I said at the very start, property investing to me it's a game of grip strength. You've got to be able to hold on. And to me, right here, right now is such a great opportunity to get into the market, whether it's your first investment property or you continuing to scale. In 10 years' time, just imagine how more expensive these properties will be. And you're financing that generally at 100%. So you're generally trying to get these no money down. So you can't expect when you're putting no cash down to get a property that continually washes its face and doesn't cost you $1. I can't sugarcoat it. That's what we're generally seeing. Most properties will require you to put in some dollars. And if you're not up for the cash flow dip, then you can't get the capital growth upside. You can't have your cake and eat it too. There's got to be a period where you will be negative to come out to a point that it will be positive, but you've just got to be able to hold on for a little while to get to the other side where it's like you've got a 50% loan to value ratio. You can choose at some point to sell some strategic assets, your mortgage, you come out of the red for a time period. But anyone that's looking for a magic answer, I'd say look in your budget and see if there's things that you can strip out. Because again, how bad do you want it? How badly do you want the capital growth? How badly do you want the financial freedom for retirement? How badly do you want the net assets that are going to produce you a 6-7% yield in retirement? Yeah, unfortunately, it's going to take a little bit of grit, and it's going to take a little bit of negative cash flow. But like any investment, it's going to be worth it if you've bought well.
Well, any good investment, that's right. But I think one also has to have the confidence in the long-term fundamentals, which is sometimes hard with the media today, Aaron, with all the negative messages. Even the recession words come up a little bit, and there's challenges overseas and interest rate issues, and maybe rates won't go down as fast as we like. What I do know is that there are some underlying fundamentals that are going to push property values up over between now and the end of this decade, over the next 5 years. We've got still growing population, which even if either side of politics reduces immigration a bit, there's still going to be strongly growing population. We're just not building enough accommodation. And interestingly, all the new properties that are coming out of the ground are going to have to be more expensive because of increased construction costs, supply chain shortages, increased labour costs. I know there's an affordability crisis, but the new properties are not going to come out of the ground, Aaron, until they're financially viable for developers to do that. And they're not going to do it until property values increase. But you can't just increase value of new properties if the established properties don't increase, if the gap gets too wide. That's why people they know they've got to pay a bit more for a new property, but they're not going to be prepared to pay a large amount more. So in my mind, that just means that current properties are available with inbuilt intrinsic value. You couldn't replace them at this cost if you own the right sort of property. So I agree with you. Be comfortable with the fundamentals that if you buy the right property, have the right finance structure in place, insure yourself, which is, I'm not allowed to give insurance advice. I'm not licensed for that, but you're one of your biggest assets, as you kept saying, your income earning capacity. And just see what the other Australians have done, the wealthy ones, and don't pay attention to that group of property pessimists that are on the internet that tell you it's rude and taking advantage of tenants. I think it's our job to look after our financial future, because I know the government's not going to.
Correct, mate. If anyone's waiting, I mean, think about, I've been working and super has been with me my whole life since day dot. I'm not expecting any government support when I get to retirement. I think anyone that's reliant on government support when they get to retirement, that's a very bad outcome. I'd be doing everything I can to be self-sufficient. They make changes on those policies. You're a sitting duck. The cost of living will continue to increase. Stack the deck in your favor. And who's going to be there? And if you're going to put that burden on your children, just imagine how hard it will be I'm looking at my daughters 6 and 4, how hard it will be for them to get into the property market in like 20 something years, for example. If I'm not making moves now, that next generation, will be a series of haves and have-nots between who their parents are asset-backed, i.e. property, versus not. It pains me.
It's a shame. It's not fair in this lovely country we live in, but it's a fact, isn't it?
Look, you can dig your head in the sand, or you can acknowledge it and go, that gap is just going to continue to get bigger, and that divide will continue to drive more Australians between property owners and not. I'm not making the rules, and I merely see what on a day-to-day basis where property has allowed people to accelerate their wealth journey versus the people that don't have property, and rents will just continue to go up. And so which side of the fence do you want to be on? It's like taking control of your future or being a victim of your future. And I really feel like that victim mentality will not serve you into retirement. You've got to take ownership of what you want to achieve and move the needle, because no one's going to come and save you. The government isn't going to slow down house price growth to let others catch up. And that's a harsh reality. And I know which side of the fence I want to be on. And that's the side that's going to continue to let the market increase property prices.
Well, I think we're preaching to the people watching this and listening to this podcast. But Aaron, I'm going to leave a link in the show notes to your podcast, the Australian Property Podcast, and also to Atelier Wealth if people want to know more about what you do. But maybe we should just finish off by saying that if you do the hard things now, you are going to have an easier life later. But as you said, if you do the easy things now, unfortunately, you're probably going to end up having a harder life later on, Aaron.
It doesn't matter if you're investing in property, if you're trying to get fit and healthy. There's so many ways to get fit and healthy. You could swim, you could go to the gym, you could do yoga. So take modalities, and you'd say the same thing could happen in property investing. There's so many modalities to do it, but it's like you've just got to take action. And it'd be the same in our businesses. Business owners that want to go and achieve some type of financial success in their respective field or business or industry, they had to go through an early part in that journey where things didn't work. Cash flow was poor, ideas weren't landing, but as a matter of who could get up, keep going, keep persisting. And the same would happen in property investing, where it's the numbers are almost eerily similar. People that start a business and don't last 18 months, 3 years. People that have one investment property that can't get to 3, for example, that can't get past 6, that can't get past 10. And it's a matter of, hey, if you've made a bad decision, how quickly can you course correct? If you've got bad cash flow, how quickly can you move to positive cash flow or have buffers in place? Who can have insurances in place, like you mentioned before as well? Like in business, our insurances are probably the lifeblood of our business. Going risk management, the same thing would happen with properties and protecting the assets that you have as well, personally and property. And then I think the next part really is the X factor, which is who's got that mindset for growth and abundance versus who lives in a place of scarcity and looking at everything that can go wrong. The people that are constantly focusing on what can go wrong with their investment property journey will live in that space versus the people that are going, what can go right? I can get this property revalued. I can increase my rent. I can go and buy another property. I can have the ability to set up a trust. I now get to have independent legal advice. They're the ones that are going to succeed. And if you've got to the end of this episode and you're going, hey, you didn't tell me about interest rates, I'm sorry to disappoint you, but the game isn't about rates. The game is about the stacking the deck in your favor.
Well said. So I don't know any rich pessimists around, but I know a lot of optimistic people who've done well in life. Thank you for your time, Aaron, and I look forward to having a chat again sometime real soon.
I appreciate it, mate. I've always said this about yourself, mate. I've really looked up to what you've done, the information that you've put out there. It's inspired people like me to, kick off a podcast and a book. It's all played part of my journey. And if our conversation has just given someone that nudge on their journey to keep going, I'd say mission accomplished, right?
Well done. Thank you, Aaron.
Thank you, mate.
That was a great chat with Aaron Christie-David, and in a moment I'm going to share with you my popular mindset message about which wolf you're going to feed. You better wait for that. But in the meantime, I just want to point out what Aaron and I were saying a moment ago, that the market's moving into the next phase of the property cycle. Over the next year, interest rates are going to keep falling. And in general, when interest rates decline, the market tends to experience a surge in activities. I mean, more buyers come in because they can afford larger loans, but more so because they've got more confidence now that interest rates aren't going to creep up against them. And the market tends to experience a surge in activity. Buyers can afford more loans, the demand escalates, property prices go up, Sellers now decide to put their properties on the market. And at some stage, buyers who were previously out of the market because they were just a bit stretched start to re-enter as well because they've got a little bit of extra borrowing capacity. And all this creates a snowball effect that in the past, as interest rates drop, rapidly pushes up property values. However, here's a takeaway I'd like to share with you today. Waiting for rates to drop might mean missing out. So I see the current market as a window of opportunity for property investors with a long-term focus, just like Aaron and I were speaking about. Now, I'm not suggesting you try and time the market. That's too difficult. You missed the bottom at the beginning of 2023. But if the market hands you an opportunity like this to get involved at the next stage, the next phase of the cycle, as interest rates fall and there's another resurgence, why not take advantage of that? So I'm going to suggest you have a chat with, even if you're not ready to get going yet, have a chat with one of our wealth strategists at Metropole. Get your ducks in a row. Why not plan to become the person you plan to become by having a strategic plan put in place and then allowing Metropole to help you implement that plan? You're going to find we're much, much more than just a buyer's agent. We help our clients actively grow, protect and pass on their wealth through strategic property, but also wealth advice. We're big enough to tip the scales in your favour, but still small enough to care. So go to metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'm going to ask you, which wolf will you feed? I came across this story a while ago about an old Native American. A grandfather takes his grandson on a walk and he's sharing his wisdom for life. And he tells the boy, a fight's going on inside me. It's a terrible fight between two wolves. One is bad. He's anger, fear, hate, jealousy, and envy. And the other one, he's good. He's hope, kindness, joy, love, optimism. And the boy asks, Grandpa, which wolf will win? To which the grandfather replies, the one that you feed. Now, as I think about this story, I gather that we've all got two wolves inside us. If you choose to feed the dark wolf, you'll be filled with anger, with fear, with hate, with jealousy, and with envy. If you instead feed the light wolf, you'll be filled with hope, with kindness, with joy, with love, with optimism. So, which wolf will you feed? My mentorship, my mindset message for you today is, remember, the choice of which wolf you feed is yours, so choose wisely. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?